Let's look at JetBlue and calculate the intrinsic value of the stock using a discounted cash flow model. So what we're going to do is estimate the future free cash flow of the company, discount it back to today's dollars, and then compare that to the current price they're trading at. And I'm doing this video because today Latam, a Chilean airline, filed bankruptcy. They filed Chapter 11. They're actually the largest airline in Latin America. And early this month, Avianca Airline, that's the largest airline in Colombia, they filed bankruptcy too. So it's not just American airlines that are struggling, it's also other airlines around the world as well. So let's see. So JetBlue has 2.845 billion in market cap, and they're trading at 10.56. So they have 269 million shares outstanding. And the way you find the intrinsic value of a company, you have to estimate the future free cash flows, and because that's the money, the cash flows are the money that's left over after operating the business each year. So in 2019, JetBlue had $293 million left over after operations. So it's the actual cash that goes in or out. You don't use net income, as a lot of people use, because net income is a lot of manipulation based on depreciation and a lot of like timing issues. So it's hard to really look at net income unless you really understand accounting and you have a good grasp of all the other numbers accompanied. But you might have to go back a decade to see when the cash came in, because they may be reporting some cash now from 10 years ago. So it's very confusing and there's no way to link it together. If you were looking at a small business, then the cash they receive is the cash they report. But if you're looking at a big business that has a lot of inventory or a lot of a large operation, they do a matching method where they match the cash to when the service or the product has been completed. So they had a good free cash flow in 2016, 621 million, but then it's dropped a little bit. But it's hard to tell with free cash flow because it's actual cash. So there could have been some years they made a large investment in the business, like they bought more planes in a certain year, so the cash flow is lower. And net income is also all over the place, but it's positive, which is good. And revenue is always the smoothest from year to year. As you can see, it just goes up about 5 to 10% a year. Now let's look at that capital structure, because now that we know the future free cash flows, we have to see how much we're going to discount that by. They only have 65 million in interest expense. That's the interest they pay on the debt. And let's see how much debt they have. Can't be too much if they only have 65 million. So the current debt is 344 million. And the long-term debt is 2 billion. So they pay a little under 3% on the debt, but as you know, interest, you get a tax deduction with interest. So let's see their effective tax rate. Income before tax. So they pay 26% of taxes. So even though they pay 2.78% on the interest, the cost to them is 2.06% because you reduce it by your tax rate. Now let's see the cost of equity. And we need the beta. And they have a decent beta, 1.36, so it's not too volatile. So they only have a 12.76% cost of equity. And the way we figure out the WACC is we have to combine the debt and equity. The numbers in yellow. So they have, it's roughly 50% debt, 50% equity. and the WACC is 7.94%. So we'll discount the future free cash flows by that 7.94%. And we calculated those cash flows, and the way we did it, we extrapolated the numbers from the net income, revenue, and the free cash flow from the prior 4 years. So we don't want to go back too far, like 6 years, 10 years, 20 years, because it's so different. Usually the closer you are to your data, the more on par you'll be with your estimates. But estimates are like the word says, estimates. So you'll never be exactly. This is just to give you an idea. But if we discount these cash flows to today's dollars, we get this. And the total value of the company is $8.3 billion according to our discounted cash flow model. And then when we divide that by the number of shares outstanding, 269 million, we get a stock price of $30.88, which is a lot higher than they're trading at. Let's just see. I think what would be a conservative approach, we usually assume a 2.5% growth rate in free cash flow because that's about your inflation. But since this is an airline and they're probably not going to be doing as much business the next few years, let's do a 0% growth rate to make it a little more conservative estimate. So now it's down to $22.49, and it's still at a 53% discount, the stock. And if you look at the stock the past few years, it was trading around that low 20s number at intrinsic value. So it was trading what the company was worth for a while. But then when coronavirus hit, the stock dropped. So why won't people pay what it's worth? Well, because what it's worth in the past isn't necessarily what it's worth in the future. And a lot of people are saying that I'm not going to pay $22, and they drove the price down to $10.56. And until I guess people feel more comfortable with airlines, and obviously with coronavirus, the stock probably won't get driven up too much more. But I think this is probably a good company at this point. They're pretty healthy, and I think they'll make it through the pandemic. American Airlines, on the other case, I don't think they're going to make it through. Delta and United, they should, but JetBlue probably will be in much better shape than those companies. But let me know what you think. This is just my opinion. Everybody has their own opinion on stocks. So leave a comment. Thanks for watching.